Assalamualaikum and good day to Dr. Abdul Aziz Lai Muhammad Fikri Lai. My name is Nur Hamuddin from the group MGT646. In this video, I'm going to present a quantitative research method titled Monetary Policy Impact on Stock Market Performance in Malaysia. The content has 5 chapters which include the introduction, literature review, research methodology, results and analysis, and conclusion and recommendations. This study explores how monetary policy influences stock market performance in Malaysia, with a particular focus on the Kuala Lumpur Stock Exchange. As the central bank, Bank Negara Malaysia plays a role in maintaining economic stability by regulating key macroeconomic factors. These include real interest rates, inflation rates, and the real effective exchange rate, all of which have a significant impact on the stock market. The main aim of this study is to explore the relationship between these economic indicators and the performance of the stock market. To achieve this, the research is broken down into 3 main objectives. First is to examine how changes in the real interest rate affect the performance of the KLSE. This is important because interest rate can influence the cost of borrowing, which in turn impacts business investment and consumer spending, ultimately affecting the stock market. Second is to analyze the relationship between the inflation rate measured by Consumer Price Index and the stock market. Second is to analyze the relationship between the inflation rate measured by the Consumer Price Index and the stock market. Inflation can reduce purchasing power and increase uncertainty in the economy, which might influence investor behavior and stock market performance. Lastly, the study will investigate how the real effective exchange rate index influences the KLSE. The exchange rate can have a significant impact on trade and investment flows, and changes in the exchange rate can affect the competitiveness of businesses, which can in turn influence stock market performance. This study is important for several reasons. First, it helps policymakers, especially those at Bank Negara Malaysia, understand how their decisions on monetary policy, such as setting interest rates or controlling inflation, can affect the stock market. By learning about these connections, they can make better decisions that help maintain financial stability and promote economic growth. For investors, this research offers useful insights into how changes in interest rates, inflation, and exchange rates impact stock market trends. Understanding this factor will help investors predict how the market might move, manage risk, and feel more confident in making investment decisions. This in turn can encourage more participation in Malaysia's financial market. For an academic perspective, this study is valuable because it looks at how monetary policy affects the stock market, specifically in Malaysia. It fills a gap in existing research, contributing to a better understanding of how monetary policy works in emerging economies. The chapter will begin by explaining the main theory that guides the study. I will discuss 2 important economic theories, the efficient market hypothesis and Keynesian economics. These theories help explain how macroeconomic factors influence the economy. The first theory is the efficient market hypothesis, suggesting that stock prices fully reflect all available information, including economic factors like interest rates, inflation, and exchange rates. According to EMH, it is possible for investors to consistently outperform the market by predicting stock prices or selecting stocks. The theory divides market efficiency into 3 levels: weak, semi-strong, and strong. The second theory is Keynesian economics, emphasizes the role of aggregate demand in shaping economic performance, especially during recession or inflation. Keynes' economic challenge the belief that free markets ensure full employment, advocating for government intervention to stabilize the economy. In research methodology, the study adopts a quantitative approach using time series analysis to examine how monetary policy variables affect stock market performance. The research applies an empirical model to analyze the relationships between these variables and KLSE performance. The study utilizes secondary data collected over a 30-year period from 1994 to 2023, with all variables recorded annually. The data was obtained from reliable and widely recognized sources. Information on KLSE performance was sourced from Bursa Malaysia, while economic variables such as real interest rates, inflation rates, and the real effective exchange rates index were extracted from the World Bank databases. These sources were chosen based on recommendations from previous studies to ensure accuracy and credibility. This study adopts the time series analysis as its research framework to examine how monetary policy variables influence stock market performance in Malaysia. In Malaysian context, similar frameworks have been applied in past research. For example, Tanji Prom 2012 explored how macroeconomic indicators affect stock returns in Southeast Asia, while Rahman 2019 examined the impact of interest rates and inflation on Bursa Malaysia. So these studies highlights the effectiveness of time series models in capturing the dynamic relationship between economic conditions and stock market performance. In this study, we used time series analysis to examine how monetary policy instruments impact stock market performance in Malaysia. By analyzing past data, we can gain insights into how these factors influence stock market movements and predict future trends. To ensure the reliability of our analysis, we applied the unit root test to check whether the data is stationary or non-stationary. The study adopts the following empirical model equation to examine the relationship between stock market performance and monetary policy instruments. The augmented Dickey-Fuller test was performed to determine whether the data is stationary or not. A stationary time series means that its statistical properties such as mean and variance remain constant over time. If a series is non-stationary, it could lead to misleading results in further analysis. Our findings show that some variables were initially non-stationary, meaning their values change unpredictably over time. However, after applying first differencing, the data becomes stationary, allowing us to proceed with further analysis. Next, we conducted the Johansson configuration test to check whether there is a long-term relationship between stock market performance and the macroeconomic indicators. The results confirm that these variables move together over time, suggesting a stable relationship between them. This means that despite short-term fluctuations, the stock market is influenced by macroeconomic factors in the long run. Finally, the Granger causality test was used to determine the direction of influence between the variables. The results revealed unidirectional causality, meaning that some macroeconomic factors such as real interest rates and inflation affect stock market performance, but the reverse is not necessarily true. The findings show that interest rates have a negative impact on stock market performance, but this impact is not statistically significant. In simple terms, this means that although changes in interest rates can affect borrowing costs and company profits, they do not directly influence the stock market in Malaysia in a strong or consistent way. This finding is similar to other studies like the one by Alap and Uddin 2009, which found that in emerging economies, interest rates do not strongly determine stock market performance. Moreover, the study also found that inflation have a negative relationship with stock market performance, but this impact is not statistically significant also. In other words, while inflation can affect consumer spending, production costs, and overall economic stability, its short-term effect on stock prices in Malaysia is quite limited. This aligns with the findings of Chok and Rayapan 2018, who stated that inflation may not have a strong short-term effect, but could impact the market more in the long run. Next, we look at the real effective exchange rates. The results show that exchange rates have a strong and significant impact on stock market performance, both in the short run and the long run. This means that when the exchange rate fluctuates, it directly affects the stock market. When the exchange rate goes up, Malaysian exports become more expensive for foreign buyers, which can reduce company profits and lower investor confidence, causing stock prices to drop. This findings is supported by research from Kusaira and Yo 2019, which also found that exchange rates changes significantly influence stock markets in export-based economies like Malaysia. The descriptive statistics provide insights into the distribution, variability, and normality of the variables in this study. Stock market performance has a mean of 1247.94 and a median of 1358.91, indicating a slightly less skewed distribution. It fluctuates between 5 at 6.13 and 1 at 66.96, with a standard deviation of 420.81, suggesting moderate volatility. The skewness of -20 and kurtosis of 1.53 indicate a slightly negative skewed and flat distribution. The Harkey-Vera probability 0.2354 confirms normality. Real interest rates have a mean of 2.96 and a median of 3.30, showing a slight left skew. The values range from -3.90 to 11.78, with a standard deviation of 3.76, reflecting notable variation. The skewness of 0.14 and kurtosis of 2.65 suggests a near normal distribution, supported by the Harkey-Vera probability 0.8860. Real effective exchange rates have a mean of 97.25 and a median of 97.52, indicating asymmetrical distributions. It ranges from 80.05 to 124.89, with standard deviation of 11.61, showing moderate fluctuations. The scores of 0.91 and kurtosis of 3.37 align with normality, confirmed by Harkey-Vera probability 0.1169. Inflation rates have a mean of 2.39 and a median of 2.29, showing a nearly symmetrical distribution. The range is a negative 1.14 to 5.44 with a standard deviation of 1.38, indicating low volatility. The skewness of a negative 0.003 and kurtosis of 3.50 suggests a slightly peaked distribution with a Haruki-Bera probability 0.8553, confirming normality. Based on the regression results, the only independent variable that has a significant impact on stock market performance is the real effective exchange rate. This means that REER has a statistically significant influence on stock market performance. More specifically, if all other factors remain unchanged, a 1 unit increase in REER would lead to a drop of about 15.29 units in stock market performance. On the other hand, real interest rates and inflation rates do not show significant impact. The p-value for inflation and interest rates, both of which are greater than 0.05, indicating that these variables do not have statistically significant relationships with stock market performance. In conclusion, based on the overall test and analysis, the Johansen co-integration test confirmed that long-term relationship between monetary policy and stock market performance, emphasizing the importance of monetary stability. The Grenke causality test showed that REER significantly influenced stock market performance, while the effects of inflation and the interest rate were less pronounced. The OLS regression further confirmed that REER has a statistically significant negative impact, suggesting Malaysia's stock market is highly sensitive to exchange rate fluctuations, reflecting the country's trade reliance. These findings highlight the crucial role of exchange rate stability in shaping investors' confidence and economic growth, with depreciation boosting market performance through improved export competitiveness. However, short-term effects of interest rate and inflation appears less significant compared to exchange rates. This study provides valuable insights for policymakers, investors, and analysts in understanding the interplay between monetary policy and stock market behavior. Future research could incorporate additional factors like fiscal policies, political stability, or global shocks to enhance the analysis. Based on our research findings, several strategies can be adopted to improve the effectiveness of monetary policy in supporting stock market performance and overall economic stability in Malaysia. First, it's important to strengthen interest rate policies. Since interest rates significantly affect the stock market, policymakers at Bank Negara Malaysia should aim for a balanced approach that reduces market volatility. While lower interest rates can encourage investments, especially during economic slowdowns, overly aggressive cuts should be avoided to prevent inflation and financial instability. Next, inflation management should be enhanced. Inflation directly impacts stock market performance, so maintaining moderate inflation levels is essential to foster investor confidence. The government can use fiscal and monetary measures to stabilize prices, which in turn can encourage both local and foreign investments. Third, maintaining exchange rate stability is crucial. The real effective exchange rate affects the competitiveness of Malaysia's export sectors, which in turn impacts the stock market. Policymakers should ensure exchange rate stability, especially during times for external economic disruptions, as exchange rate volatility can discourage foreign investment. Fourth, transparency in monetary policy. Clear communication from BNM about policy goals, decisions, and expected outcomes helps manage investor expectations and reduces uncertainty in the market. This builds trust and makes it easier for investors to make informed decisions. Fifth, promoting financial literacy and market education is important. Educating the public on how monetary policy affects the stock market can help investors make better decisions and reduce market volatility during policy changes. Finally, strengthening collaboration between the public, private, and government sectors is essential. By working together, the sectors can create a stable economic environment that supports the stock market, fosters innovation, and encourages long-term investments. These recommendations provide a framework for bridging the gap between monetary policy and stock market performance, helping to ensure sustainable economic and financial growth. I think that is all for my presentation. Thank you for listening.